What's up, everyone, and welcome to the daily macro update for Wednesday, August 13th. Taking a look at this chart that we have right here, this is the target rate probabilities for the September Fed meeting, with it now having just an ever so slightly chance of a 50 basis point cut. That's what the market is potentially pricing in here, and so we're going to go over that. Nothing too crazy in terms of macro data today, but just a reminder. What's interesting is that, I've been trying to look for, other experts' commentary on this. And I think that the reason why the market is pricing in such aggressive cuts is because it's not convinced that the bond market will revolt on inflation reaccelerating. Because, inflation is set to reaccelerate here. Right, you see core inflation remaining near 3%, as well as when you take a look at the main inflation gauge that the Fed takes a look at, right, and tracks, which is the core PCE number, right? So right now, core PCE is standing at 2.8%, and it has been accelerating for 2 consecutive months since April of 2025, right? So it rose in May, and it rose in June. The pre-pandemic average for core PCE was, around like 1.7, 1.6. And so, with it being around 2.8, that's clearly not, trending down towards the Fed's goal. And so with this rising on easier comparisons compared to last year, you're going to have upward pressure on this. And, it's not just me saying this. When you take a look at the Cleveland Fed's inflation nowcast, which I do agree this thing can change, it's clearly showing that this is going to rise from where it's at right now from 2.8% to 2.9% in July. So the number that we get in 2 weeks. And then to 3% in August print. So you're telling me that the main inflation gauge that the Fed takes a look at is set to rise over 1% from its target rate for 4 consecutive months in a row leading up to this rate cut. That's essentially what the bond market is saying, and it's essentially saying that it doesn't really care about inflation right now. It's worried mostly about decelerating growth. Okay. Now, when you take a look at the 30-year government bond yield, it's still higher than where it was back at the beginning of August, just a couple weeks ago, as well as the beginning of July. In fact, this has been trending upward for, pretty much the entire year of 2025, right? So rates have remained elevated. One of the main things that I like to track for the most leading indicator from the bond market is 13-week bills, right? So this is the IRX.P, and I have it marked right here in white for where, you would definitely have it being pricing in a 25 basis point cut. It's not quite there just yet. So, it would still have to drop meaningfully from here, which, it already has had a huge drop since we had, the jobs report number 3 weeks ago, right? So it definitely has dropped pretty far. It's dropped down to levels that we haven't really seen since April, from when the market had a crash. So, or, that correction that we had. So there is still some room to go here for us to, for me to at least, to be convinced that the bond market has fully priced in a 25 basis point cut. And so I think that the Fed futures market is a little bit more volatile, and there are some things that it's not considering. Now, again, the Fed, according to, both the bond market and the futures market, is going to cut, and I'm not going to fight that, right? I don't choose what I want the market to do in my portfolio. I have to do what the market is doing. at the end of the day, right? If you position yourself in a way where you are hoping something is going to happen instead of just looking at what the signals in reality are saying, you can get yourself into a lot of trouble. And so that's what we don't want to do right now. But the reality is that they're cutting inflation. They're cutting as inflation is accelerating, and as much of a policy stake that might be, you have to do what's going to happen, right? Now, I just want to remind people on the call here that this was a similar setup just 1 year ago. If you remember the bond market, if we look at the 10-year U.S. government bond yield heading into the September FOMC, you had a pretty long, drawn-out drop in yields up until the Fed meeting. And then right after the Fed meeting, what happened to interest rates? They shot up 100 basis points because the inflation dragon was not tamed. And the market was celebrating the most recent CPI number yesterday because of the fact that these initial readings of tariffs were not the sole contributor of inflation rising. And so with the Fed's most recent guidance being that they're pretty uncertain because of where inflation will be with tariffs, seeing that in this most recent report that the majority of inflation came from medical services, used cars, things that have nothing to do with tariffs or indirectly to do with tariffs. Someone yesterday sent me a DM saying that they worked in the medical center and that they see a lot of their medical supplies go up in price from these tariffs. And even though they're services, they're still being affected, and that is true, right? Services based or services that require goods that might be subject to tariffs. I mean, they're going to have to put a markup on top of that, right? Included with its labor, with the services labor. Now, labor will probably make up the majority of it, but still, you can still have direct inflation from tariffs into these services types of names. So again, it doesn't make too much sense, that narrative that tariff inflation is just not being priced in, as it can be priced in indirectly into services. And so if this ends up being the wrong policy mistake again, where they cut by 25 basis points and then they end up reaccelerating, or the interest rates just continue to accelerate, then that would obviously be the bond market saying that the Fed made a mistake again, which could happen. I mean, you're already much higher than where we were this time last year, right? This time last year, the 10-year was around 3.6%, and right now it's at 4.23, 4.24. So obviously, the bond market is pricing in some type of, inflation reaccelerating here. So, we continue being within the bounds of this stagflationary ping pong, because I do agree that growth is definitely slowing. The only problem is that when growth is slowing while prices are remaining sticky, that's like the worst environment that you can be in, right? That's stagflation, the Fed's worst nightmare. And so, I think if the Fed ends up not cutting, then Jerome Powell is just going to get fired from his position by Trump. And then, if he ends up cutting, then you could have a bond market revolt. So it's really a lose-lose situation for good old Jerome Powell. And, I'm sure he's counting down the days in his calendar here where he retires. I'm sure he's done with the job. But yeah, I mean, even when he's out of there, Trump might want to put someone in who is a little bit more dovish. But again, you're just going to continue having inflation be a problem. Now, what does this mean for you and I, right? What this means is that, liquidity is just going to remain being injected into the markets. And so large assets, as well as ones that are in bullish trend right now, those are going to continue to benefit from what's going on. And so, yeah, I mean, large mega caps, the market continuing to go up, volatility being suppressed, gold kind of just, inching up. I think that's going to continue to happen. I mean, look at the price of silver. If you guys want to know if tariffs are for real, just look at the price of silver. Since the start of 2025, the SLV ETF is up 33.73%. There's your tariff inflation right there. What about how about some of these other industrial metals like palladium or platinum rather? Platinum is up 48.8% since the start of the year. Look at that huge acceleration. There's your tariff inflation. So again, the mainstream media narratives can say all they want, but inflation is definitely reaccelerating here. You wouldn't be having these large spikes in prices. And again, I'm going to do what the market is signaling. I'm not going to position myself the way that I think should be best, because that's not how you make money. I'm not in here. I don't make this content, and my research partners and I didn't create macro optics so that we can just go on and be right all the time. We're wrong a lot of the time. But the thing is that when we are wrong, we don't continue being wrong, meaning that we don't just stubbornly, stay in those positions that are losing. We cut the losers and we transition into things that are actually winning. And you do that as fast as possible so that your losses aren't as much, or your small losses don't turn into bigger losses. Let me see this book here. Which one is it? This one right here, I highly recommend for people. I don't do sponsors on this channel, so you'll never hear me talk about sponsors. All we do is promote our own products. But this book right here, The Art of Contrary Thinking by Humphrey B. Neal. Get yourself a copy of this one. It's a very short read. See how thin that is? I think it's 160 pages. This will give you a pretty decent viewpoint on kind of the way that we like to think of things. It's just a great book to just not being sucked into a lot of what the mainstream media is doing. And it's directly applicable to your trading strategy. Highly recommend that book. All right. In any case, look what other signals are saying. Look at Bitcoin. Look at Ethereum. These things do well. I haven't seen Ethereum do this type of move since 2021. Right? You don't have to be a super genius to see that the market is itself pricing in inflation accelerating. When you see Ethereum and some of these other altcoins that haven't done this well since 2021. And so if the Fed cuts rates, or when they cut rates, and you have another reacceleration in inflation, you're going to have problems. Now, in the meantime, again, I'm going to remain long things that are long. Let's take a look at the S&P 500 here. The market just closed. New all-time highs, right at the top end of the trading range. Man, it closed right at the top of the trading range. Look at that. Look at that. This is our trading range model indicator within TradingView. For those who are partners in our partnership circle membership, you have access to this indicator so that you can apply it to any type of asset that you want that's available in TradingView. As well as we have a bunch of other indicators as well that you can use that are strictly for our members. But yeah, this went right to the top end of the trading range, and this was a great time to sell some, right? Volume has been decelerating. So we're having a bit of a bearish divergence here. Still, great time to sell some. While most people are chasing these past couple days, our group was buying, back at the beginning of August during this dip here. I mean, it was clearly a buy the dip moment right there. But yeah, so hopefully you guys were able to take advantage of some of this dip that happened a couple weeks ago, and you are net sellers into the strength so that you can buy lower whenever the next dip comes. That's how you do it. I think that's how you do it, right? Buy low, sell high? Or is it buy high, sell low? For a while, I was buying high and selling low. But the process, a process that you can lean on that doesn't require and fades your emotions, that's what you want to use all the time. Jack Hammer asks, what is the logic of the trading range indicator? Great question. So the low end of the trading range is where typically if something is in a bullish trend, that provides an opportunity where you can buy some, right? So whenever it gets to this green range right here, that's typically where I'm buying some, but not all the time, right? You still have to use correlations. You still have to see the context of that move, right? Just like how, like when you're talking with somebody in person, they can say the same thing on paper, but it can be meaning two different things based on their tone. Similar to that, right? The charts speak to you. So think of the price chart as the words on the paper, and then you use volume and volatility as well as correlations to give you the tone of which that was said, right? So context matters on all these different price moves. What do I mean? What do I mean by that? So if the S&P 500 is falling in price down to the low end of the trading range, and it's not that on that much volume, right? So volume didn't accelerate, or maybe it did just a little bit, but nothing too crazy. And then maybe you're still seeing, lower volatility. Maybe you didn't get a huge spike in volatility on that move. And then other correlated assets to the S&P 500, maybe they didn't have as much of a drop. Or, maybe they did, and they're also still in bullish trend at the low end of the trading range and nothing has changed in the macro. Those are all clear signs of a buy. An example of something not to buy, just, we can do an example like we did in our report yesterday. As the S&P 500 continues higher, as well as, Bitcoin, take a look at something like Coinbase, ticker COIN. This thing has lost a tremendous amount of trend strength. And it did go to the low end of the trading range, which you could have bought if you were just mechanically looking at this for, a nice little 10% gain, which sometimes you can do that if you're a super short-term trader and you just want to use the ranges for those short-term trades. Went right to the top end of the trading range today and then closed down. So that would have been a great move. But still, this was not this did not come down, maintain trend, and then continue higher. So it's been losing correlation to other bullish assets, which means it's not as attractive at the low end of the trading range than something else. All these things, my team and I track for all asset classes so that you know exactly out of, all the 3,000 stocks and thousands of ETFs that are out there, what are the select handful that are the best ones out of those. The process that we use clears all that up, and that's what we do in our community. So, and all of that is in the context of macro data. Again, like I'm human, right? Which means I'm subject to my emotions. We have developed this process so that I can use this myself. It's not like I'm just, showing this and I'm not using it. This is the exact tools that I use to be able to do this full time. Right? So, if that sounds like something you want to learn more about, just head to our website. No pressure though. We really are just trying to find people who are seriously interested in this stuff, who want to be a part of a community. Our goal isn't to just Get as many subscribers as possible. That's why, you don't see us doing paid ads or anything like that. All word of mouth, as well as people who watch these videos. But getting back to the charts here, it is just interesting how, we're continuing to make all-time highs at a lower market breadth, meaning that look at 2021. During the 2021 all-time highs, over 91% of all the stocks in the S&P 500 were above their 200-day moving average. And then let's go to 2024 all-time highs. Now the average is down to 74, 75%. So we went from 91% of stocks doing well down to 74%. And now at the timing of this video with new all-time highs, we're at 58%. So nearly half the stock market is, below their 200-day moving average, even though we're at new all-time highs, which means there's a very heavy concentration in just a select few names, which are the large mega caps, some of which were having a decent correction here. Microsoft finally having a little bit of a correction, but not yet at the low of the trading range. Tesla went bullish in the model. So for those people who like to trade Tesla, this just went bullish in the model here. So that's something new. Pretty much the only bearish trending top 10 stock is Berkshire. BRK.B. Everything else is bullish. All right, let's get into some questions here. I see the questions on TikTok. We'll get to that in a second. People on YouTube, I see you there, as well as Instagram. Decent amount of comments today, so I'll just get through them as much as possible. Let's see. Nobuki says, are gold miners starting to catch up to the increase in gold price? That's not necessarily how it works. Gold miners, even though they're related to the underlying commodity, they're still completely different in how they behave. But gold miners are actually in a lot better of a bullish position than gold is. See, look at the chart. Let's look at the difference here. See that? Which one's more bullish? Gold miners or gold? Obviously, gold miners is in a much more bullish trend, right? And so, it's just the way that it is. There's really no reason to think about the reason why things are happening. It's good to know historical context for sure, but it's happening because it is a lot of the time. But yeah, I mean, gold miners still, they are doing well because the underlying is still remaining in a bullish trend, although gold has lost some trend strength. But yeah, gold miners definitely doing well. You can even take a look at silver miners. They're also doing well too. Even copper miners look a lot different than the actual underlying copper price with that crazy drop that we had during the jobs report. But yeah, good question. Could you help me understand where is the support on Microsoft and what price needs to break to be in bearish trend? Sure, we can go over that real quick. I mean, yeah, right now Microsoft is in a very clear bullish trend. For it to break down to neutral, it would have to get below the low end of the trading range here, which is around $507. In order for it to break bearish trend, I mean, we would have to see it directionally go below that and do that on higher volume as volatility has a breakout as well. So yeah, I mean, that could be around like 498, but good question. Is the dollar back to neutral? No, the dollar is bearish. So the dollar is no longer neutral. It's actually in bearish trend according to our model. Check out royalty-based mining companies, EMX. Yeah. Definitely in bullish trend here. Things had quite the year. EMX up nearly 100%. Good one. All right, let's go on over to the Instagram comments here. What do you think about BLSH? What is that? Not even sure what that is. Is the partnership circle the same as the community or two different tiers? It's two different tiers, right? The community is just for people who are, just getting started with, learning macro. And the community aspect was, or the lower tiered community was built because a lot of people were sending me DMs saying that they don't have, enough or the involvement with their investing experience to do the partnership circle. So that's why we created the regular community for that. But if you guys are interested in it, then I would just suggest going to our website and checking out our products, and then you can just, book a call. So yeah, go to macrooptics.com, scroll down here to macro products, and then just go to the partnership circle and book a call here. And that'll take you to my calendar there. Why did copper drop so quickly? Because of tariffs, if I recall correctly, but silver and platinum have increased. Copper actually took a decent dive on the jobs report. So, yeah, I mean, I'm not really certain what that huge drop in copper was, but I don't really care. All I know is that it's, bearish, and I'm not touching it right now. So, typically copper does well when global growth is accelerating. So, maybe it going bearish is an actual signal that global growth is slowing. Is there a correlation strength between Bitcoin miners and Bitcoin miner revenue? Yeah, I mean, if miner revenue continues to go up, then, so does Bitcoin miners. All right. Copper's bearish trend. Let's go over to see some of the comments here on TikTok, and then we'll go ahead and wrap it up. If you're asking me questions on what you should do with your money, I'm not a financial advisor, so I'm just not going to answer those questions. Is a 3 rate cuts prediction driving the market? Yeah, I mean, the market is celebrating rate cuts like it always does. That's for sure. Jitender, appreciate the follow there. I usually buy high, bag hold, sell at break even. Yep, that was definitely me a while ago as well. Trump Putin catalyst for dollar to go finally back up. I don't know. We'll see. I mean, I don't try and speculate on those types of like what ifs. I always just go back to what's being signaled in the market. What do you think about these Bitcoin miners? I do like them, but some of them are bearish trend. Like for example, Mara just went bearish trend. Thoughts on copper? It's bearish. What is the price difference between Partnership Circle and the regular member of your community? You can just go on our website and check it out. The regular membership is $47 a month though, but you get a 7-day free trial. So just to make sure it's for you. Thoughts on SOLX? What is that? Soldex? Is that what it is? I don't even know what this is. whatever it is, I wouldn't be touching it because it's a bearish trend. All right, so yeah, with that, if you guys have any questions, you can always shoot me a DM on our socials. We usually have myself or someone who can reply to that. But let me see if there's anything else that's here that I wanted to cover. I guess the last thing I can just showcase is that the Chicago Fed's risk subindex continues lower, and so we're on a full-blown risk-on market right now. So if you're someone who is like hesitant because you're just on the sidelines, I mean, there's really no type of major thing right now that's going to be, stopping the current trend right now. So, I mean, yeah, hopefully you own assets. But all right, everyone, we'll go ahead and wrap it up there. Appreciate everyone for joining, and we will catch you in tomorrow's Daily Macro Update. Bye.